following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome once again to Volatility Views, the program that dives deep into the world of volatility and volatility trading. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And joining me on the Volatility Views panel, we have quite the panel in store for you today, listeners. A treat. A nice holiday treat for you, if you will. First up on the old holiday Volatility Views panel, we have none other than the man, the myth, the legend himself, good old Don Schlesinger, the major domo over there at Volex. Don, welcome back to the show.
Thank you very much. Listen, I have a question. You know, they say it's bad luck when a black cat crosses your path. I went out the other day and a black swan crossed my path. I don't know what to make of that.
I'm assuming you're referring to the fact that our listeners just won't let this one go. They are, you guys out there are apparently enthralled with our discussions of Black Swan, or perhaps infuriated, or a little bit of both. So, yeah, needless to say, our listener mailbag will be once again devoted to that most tumultuous and controversial of topics, Black Swan and Mr. Talib, and and all of the various implications therein. We thought we put it to rest last week, but you guys want more, so we're going to dive back into that fray.
I guess if we're not making half the people angry, then we're not doing it right.
Yeah, I know. So you got to keep half of them angry and keep them tuning in. You know, what's that old study they did of Rush Limbaugh years ago, Don? And they found that people who loved him tuned in for about 5 minutes on average. People who hated him tuned in for about 20. So there you go. Make them hate you and they come back begging for more. We need to be a little more controversial. That's our thing. All right, speaking of controversial, I think we have two here who can help us with that. Well, at least one. Starting off with the man from Option Pit, good old Mark Sebastian, Mr. Seabass himself. Mark, welcome back to the show, sir.
Hey, how's everybody doing today?
Very good, very good.
I'm excited to talk about all the premium Don wants to buy. Now, he believes that the skew curve is underpriced and that you can make your lives dreams come true buying premium.
Buy the preem, live the dream. Isn't that your mantra for life,
That
Mr.
is
Sebastian?
what he says.
Isn't that the subtitle of Option Pit, essentially? That's what you teach all your mentees.
Yes, that's the big thing. Actually, that's going to be my biography of Don. You know, it's going to be the story of Don Schlesinger, an option never sold.
He never met an option he didn't want to buy.
Oh, exactly. That's what he's known for. No, actually, I believe he used to say there are options that should be bought and options that should not be bought.
No,
that's what he
only
used to
two
say,
things
right?
that you ought to do with an option: sell it or don't sell it.
And
I thought it was the other way around. I thought it was buy it or don't buy it. Isn't that right?
Okay. Just a little more teasing going on.
And speaking of buying premium, degenerate premium buying, if you will, that laughter coming from the cheap seats is none other than good old Andrew Giovinazzi, who's a local boy today. He's not beaming in from the great state of Maine. He's beaming
in the cheap seats because he couldn't afford the orchestra for all the premium that he's buying.
Exactly. All that decay is just eating up at you there, Mr. Andrew. But welcome to the show to you as well, Andrew.
Yes, I'm just here in the corner playing second fiddle to Mark's running verbal fencing.
Yeah.
with Mr. Schlesinger, which
Yeah.
always makes for interesting theater.
Between Don and Jacobson, I'm having a field day this week. It's been great.
Some great tilting at the old quatrain. There's a good, there's a little old English Middle Ages reflection for you. All right, with our jousting and our fencing commenced, I think we shall dive right into our volatility review.
It's time for the Volatility Review.
All right, listeners, you know that music. That means it's time once again for our volatility review. This is, of course, the portion of the show where we look back on the week that was from a volatility perspective. And it was another intriguing week, and it's starting off as an intriguing day today. And as we're recording this in today's sessions, most of the major indices are moving slightly to the downside, with NASDAQ leading the charge down about 0.5%. The bulk of that looks like Apple once again selling off. So giving us a little bit of love on the NASDAQ vol side. Speaking of NASDAQ vol, maybe we'll mix it up and start in NASDAQ vol land. How does that sound to you, Don? What caught your eye in the week that was from a NASDAQ volatility perspective?
Well, you can say all that you want about Apple and the fact that, it's having tremendous movement and that ought to be affecting NASDAQ. It may be influencing price somewhat, but volatility is absolutely non-existent. We had a really big drop, but I mean an appreciable one. Again, judging by historical levels, 21-day trailing realized volatility. Last week's show, we left NASDAQ at 16.6, and today, believe it or not, this is NASDAQ we're talking about, 13.8. And it hardly gets any better if you go out farther. You say, well, gee, you can't sustain that. Let's look at the 3-month. The 3-month is 14.7. So this is really looking at vol cones and percentages and historically what's like, the lowest 10% in terms of what you get for NASDAQ volatility. I'm sure Mark will comment on S&P and VIX, but just to put the historical content there, S&P index volatility on the last 21 days, again, realized is 10.94. 10.94. So we're seeing very little in the way of any kind of price movement whatsoever. That's off from 14.2 last week. That's a tremendous drop for 1 week. Now, I would point out one thing. It's always important when you do a moving average. What happens is you drop the farthest 5 days, and in this sense, 5 trading days, because we come on each week, and you replace it with what happened this past week. So you have to be just a little bit careful there, because you could have had a very volatile week this past week, and if the one that it replaced a month ago was even more volatile still, the average would actually come down. So when you make these claims, as I am, that it was a quiet week, that may very well be the case, but when you're comparing to a moving average, you always have to look at the data that was dropped with respect to the new data, which is being included, because there's a relative component to that as well. But I think by any measure whatsoever, it was simply yet another very quiet week, at least on the realized volatility front.
I know realized vol is your favorite topic, Don, and you've devoted a substantial portion of your life now to that very topic. And as you mentioned, the realized versus implied discrepancy we're seeing actually not the discrepancy, but you just mentioned the low level of realized vol we're seeing right now in NASDAQ. I attended an event last night, had a lot of financial media at it, and during this event, a personal finance columnist came up to me and she was asking me a bunch of questions about why is VIX so low right now and why I'm recommending all these trades for my listeners and readers and things about low VIX and all these things. And so I was trying to walking her through all the reasons that vol is not really cheap and what the term structure is. And finally, after about 15 minutes, I kind of just washed my hands of it because I was clear it was not getting through. And she had just latched on to that VIX cash number, and that was all that she really understood or knew. And that's all she cared about was just, VIX cash is low. That's all that's what's important. And so But that just kind of, I actually, at the end of it, I recommended, why don't you come listen to a little show we do called Volatility Views?
And you know, it's curious, Mark, and of course we're going to try to promote and to market products that settle to realize volatility. All of our listeners know that. But, you know, just to make a comment with, yes, a certain bias and a certain interest, but I think it's a fair comment. The world is fixated on implied volatility and VIX and what have you, again, because there really hasn't been much in the way of alternatives. But,
right.
You know, here we are talking about volatility, and it's just fair, I think, to point out that you know, when you keep focusing on VIX, you lose sight of the actual volatility of the market. What's actually happening? What volatility is the market really displaying? Nobody ever talks about that. It's almost as if you're saying, gee, it's really cold out. But instead of taking a thermometer and measuring the temperature to prove that it's cold out, you convened 100 people and said, everybody, why don't you guess what the temperature is going to be next month? And then according to their guess, you would declare, hey, gee, it's cold out. Well, you know, for my money, I'd like to hang a thermometer outside the window and read what it says. So
I agree.
That's the fundamental difference. And, you know, I hope our listeners and eventually traders throughout the world will understand that differential there and hopefully make for some interesting trading in the months and years to come.
Well, hopefully.
Yeah, well, that's actually an interesting point. I actually brought that up yesterday, the fact that realized volatility. Don, you'll love this. You know what 10-day realized vol is in the S&P and in gold? Just take a guess.
I think the S&P has got to be awfully low according to what I just said, and
it's ticked up from yesterday to back over 6%. We were at 5.09 yesterday. We're now back up to a steamy 6% annualized volatility in the S&P. Gold is even lower than S&P vol, if you believe it or not. Well, actually, over the last 10, we got a couple of ticks. It had ticked below. Gold's at about 8%.
Yeah, I'm looking it up on our screens, at least on a 21-day basis, which is longer than what you're discussing. It's maybe like 1 point higher than S&P, but still, it's extraordinary.
Yeah, well, look at this, Don. Now, if you want to know extraordinary, I have, and this is one of those times where you certainly would say this is an option that should not be sold.
Right.
Okay? I'm looking in FXE, which is Euro currency.
Right.
I'm looking at a 2-year low in implied volatility by a long shot.
Yep.
And 20-day realized volatility and 30-day realized 20-day realized volatility, 21-day, that is actually eclipsing implied right now.
You know,
that is an option that should not be sold.
You know, our Euro FX contracts, our volatility contracts really aren't trading on the CME. They've been listed for quite a while. There's not activity. But if you go to our home page on volex.us, we still keep a chart on the front page of the vol contract, both quarterly and 1 month. And I haven't really focused on it in a while, but I see back in July it was up at about 13, and it's now at about 7.9. Talk about falling off a cliff.
That's what I'm saying. Is
look at this graph.
Eurovol, you know, Don, I know you're going to hate this. All right? I bought a straddle today in that product.
Don, just cover your ears for the next few minutes, I think, Don.
I think you're my son.
You know, I'm even if I just think vol is gonna tick higher. I don't see a way in which January vol can be below 6.75% for more than a couple of days.
The only thing I can tell you, Mark, and you're probably 100% right, so I'm not really saying this to contradict. The only thing that I can tell you is as you look at this chart that I'm looking at and you start in July, you look and say, gee, that vol's not very high. And then you go to August, gee, you know, how could it go any lower? Then you go to September, and here we are in December. It's done nothing.
I know.
But
although the one thing I'll point out, every time it's hit these kind of new lows, you do get a little bit of a relief rally at certain on each of these little pops. So, but yeah, it's just ugly, ugly, ugly. And the interesting thing is that you're not going to keep, even if realized volatility doesn't keep up, if you're smart about hedges, you can probably make money on that straddle. Because I can tell you this much, Don, I sure as heck ain't hedging dynamically.
Right.
Oh, you're Delta neutral all day, and you know it.
Oh, that's what they call me. Delta neutral Sebastian. That was my name.
So speaking of, since we hit on VIX a little bit, and hopefully my point of all that was just hoping to say that hopefully that reporter is listening and that she's getting something out of the show, and she's gone back and downloaded some archived episodes of this show, perhaps some of the early episodes where we walk through a lot of these topics in more detail. But still, it is kind of disconcerting to see so many people out there with voices for the investing public still have no real clue about any of these topics that we're really discussing on this show. And
Mark, I wrote about this on my blog last night, the S&P versus realized. The title I was obviously making fun of the Apple guy, but I said it was SPX realized volatility versus VIX spread is insanely insane. And, there was a 10-point spread, actually an 11-point spread between VIX and realized vol. I mean, the VIX is the most overpriced I've seen it, near the entire year. So the idea that vol is cheap, the VIX is not cheap. The VIX is relatively low, but it is not cheap on any level, definition, or anything like that. It's insanely expensive if you compare it to, if you consider that it's trading at a 300% premium to realized vol. I mean, that's right there. Now, Mark, kind of an interesting thing in the world of S&P, the CBOE kind of relisted their variance futures. I don't know if you saw that.
Yes, they've been working on that for ages. I remember talking to Jay over there, the CFE, the CBOE Futures Exchange.
It's actually showing volume.
Yeah, they did their homework this time. Last time they put out a product and it really didn't seem to gel at all with the standards of the OTC stuff. Yeah, it didn't work. The whole point of that product was to migrate the OTC variance swaps onto the exchange. Yet they put out a contract that pretty much didn't meet any of the specs of what the OTC crowd wanted. So it kind of failed at all of those purposes. So they really, to their credit, they kind of shut it down and went back to the drawing board and said, hey, we're going to rebuild it in a way. They spent a long time doing it. I thought they were going to launch it a lot earlier. But you're right, we've seen this from them before. They tried it. They tilted at that windmill of credit default swaps years ago, back in 2007. All the exchanges did. They all completely failed at that. Not all to their own default, but some of it was their own fault. But yeah, they tried the same thing with variance swaps. We just seen if you don't adhere to the conventions of what the market is using, what the marketplace is using, your product is going to fail. And
we were trying to figure out where the open interest came from, because we were looking at the first couple of days, and apparently there was some volume, first a couple of hundred, then maybe a couple of thousand, and we thought maybe it's just the market maker, trying to get some volume up there and show it. And then all of a sudden there was something like 80,000 on open interest, but without the corresponding trade. I don't know if you guys know if you can do something, like off exchange or something, and it doesn't show on the thing.
I don't know. I mean,
creates open interest. Where the hell did that come from?
Was it a cross? Are you allowed to cross orders on the CFE?
Yeah, I don't know. That's what we're trying to find out.
That'd be interesting. That'd be an interesting cross where it'd be a first of its kind, I think.
Yeah, no, it's kind of interesting. I don't know. Certainly, the volumes. It's trading a couple thousand a day now. I think it's going to be less. My theory is it's going to be less replacement of OTC and more where the dealers go to dump their
it'll be hedging and some layoff stuff.
Yeah,
which is how VIX started too, and then it kind of grew from there. So
helps pricing too.
And it does help with pricing a little bit.
Yeah, but, you actually have some actual standardized pricing is an interesting thing. Of course, listeners, if you want to learn more about variance swaps, I recommend you go back and listen to the whole show we did on that. I forgot what episode it is. We'll put it in the show notes. We did an entire show on variance swaps and the various conventions they're in and how ridiculously obtuse that marketplace can get sometimes.
Yeah, but Don had sent me a couple of really good papers that I was reading, and then another student started sending me some. So I'm making it a point to become.
Are you schooling yourself in the world of OTC variance swaps?
Yes, I'm going to be an OTC variance swap expert in a matter of weeks. That is my goal.
A matter of weeks. The clock is ticking. We'll check back with you for the final exam shortly in a couple of weeks. But before we close out the vol review, really quick, we've hit on VIX a little bit, obviously. We think we know where you're going to go with this, but any particular action in VIX this week really catch your eye, Mark and or Andrew?
Let me, as I look right now, there was nothing crazy. Obviously, we had upside call buyers and yada, yada, yada. But, the real interesting thing has just been the way the front month contract has really hugged the cash a lot more than normal this cycle. Been a little
it's been an odd cycle for that, where we've seen that massive disparity, and there was actually a time where they were inverted for a while there, which we haven't seen in a long time.
Yep. So
that's pretty much, I think, the telltale story of that is just everything is pretty much as we saw last week for the most part. Not too much action, but still some interesting developments, like we say, with the developments of the near-term front month future, and of course the front month VIX being much more in lockstep recently than they have been in quite a while. Can you remember the last time they were this much in lockstep or even inverted, Mark? It's been quite a while.
No, it's weird. Certainly not with the VIX. Certainly not with the trading 16. You expect them to move a lot more similarly when the VIX is trading around 20, and you'll see them move pretty well then, but not when it's really, really low. We should be seeing a big premium, and we're not.
Another one of the many weird vagaries of the VIX land. I saw an interesting. Our friend Chris Cole from the show. He's hitting the lecture circuit these days. I saw him speaking at another conference recently. I didn't see him. I read about his speech. He gave a similar speech to what he said here at the Chicago conference a few weeks back. But he's very much hitting on that VIX term structure point, to the point where even the Barron's blog is starting to pick it up. So we'll see if there's.
Mark, the episodes for variance swaps are 49 and 59.
Perfect. All right, Don. So, all right, listeners, that's going to do it for the volatility review. But before we go, Don has reminded me here in our show chat that the episodes for variance swaps were episode 49 and episode 59. So you can find those on volx.us. You can, of course, find them in iTunes and Stitcher, or you can go to our brand spanking new landing page on the optionsinsider.com. Click on the Volatility Views landing page, and you'll see all the episodes right there. So you could choose it from that as well. A lot of different ways to find our archive shows. But now, because so many of you have demanded it, we're going to go back into the mailbag yet again and dive once again into the Black Swan fray.
Listener mail. Listeners write in. Mailbugs.
All right, and welcome to the mailbag. This is, of course, the portion of the show where you, the listener, get your chance to sound off and join us here on the Vol Views panel. And Don, I know we have one here that caught your attention because it's addressed to you. So we'll start with that one, because I know you've been champing at the bit to talk about this one for a while now.
Don, even though you're much smarter than me, here's why you're wrong. Don't you love that?
Well, this is our old friend Asymmetric Risk. He liked our show on Black Swan a couple weeks ago. He had some issues with it. We talked about. He made a comment on the show last week that we discussed. He's chiming in again with a comment directed at you, Don. So I'll let you have the first swing at this. He writes, according to Don, Nassim will lose money over the long run because the out-of-the-money options he buys have a higher implied volatility than the close-to-the-money options he sells. Since he is paying a spread, Don thinks this is a bad strategy. Far be it from me to disagree with Don, but speaking for Nassim, and I feel confident we're speaking for him because I've had dozens of conversations with him on this exact topic, Nassim would agree that he is paying a spread, but the spread between the at-the-money and the out-of-the-money options is systemically underpriced. Nassim's strategy is based on his belief that asset prices are not normally distributed. The bell is flatter and the tails are fatter. So options markets overprice standard deviation risk, which he refers to when Nassim said, I always sell at the money straddles, and underpriced 2 standard deviation risk, which he says in parentheses are the Black Swans. And maybe we'll take some issue with that characterization, but we'll see.
Yep.
He says, your critique of him is misplaced because you're focusing on 5 and 10 sigma events, which are not required for his strategy to work. He ran a large option book at a major investment bank and was profitable on a monthly basis. And Don, I know you're dying to get into this, so let me just really quick before you do that, because I saw his characterization. I know you're going to take issue with that. I take a little bit of issue with that too, because it seems like we are kind of playing with that term of what a black swan is. So I happened to pull up here before the show the exact paragraph that describes it in his now infamous book, Black Swan. He writes, Black Swan is an event with the following 3 attributes. First, it is an outlier, as it lies outside the realm of regular expectations because nothing in the past can convincingly point to its possibility. Second, it carries an extreme impact, unlike the bird. Third, in spite of its outlier status, human nature makes us concoct explanations for its occurrence after the fact, making it explainable and predictable. So he says, I summarize it by saying rarity, extreme impact, and retrospective, though not prospective, predictability. So that is kind of at odds with a 2 standard deviation move. Maybe we'll get to that in a minute. I wanted to just frame the conversation like that.
Anybody would say 2 standard deviations is some sort of really unusual move,
but it is certainly not unexpected. So nowhere near kind of what his book would describe as a black swan. Sorry, Don, you have at it. Just wanted to throw in.
It's not a problem, and you've both made points that I surely would have made. And Mark, it's interesting that you pulled that out because I actually went to my bookshelf and I went to
we both had the same thought. We had to go back to the source to see if we had maybe misconstrued it ourselves.
Yeah, I went to the dust jacket and, a highly improbable event with the 3 characteristics that you mentioned. It's unpredictable. It carries a massive impact. And, the astonishing success of Google was a black swan. So was 9/11. So you're talking about things. And now, as the other Mark says, that surely are not defined by 2 standard deviations, which, is 4.6% in the 2 tails combined, and basically, happening once every 21 or 22 days. Well, that's once a month. There's only 21 trading days in a month. So what you're saying is you're defining a black swan event as something that happens every month on average. So that's just simply not accurate by anyone's definition. But so I have a few other comments, and I could kind of start at the end. And with all due respect, so you make a comment, he ran a large option book at a major investment bank and was profitable on a monthly basis. Well, that very well may be the truth, but it doesn't argue at all whatsoever for, buying back spreads as the reason or the source of his profitability. Let's suppose you decided that you were going to sell at the money straddles because you thought that was a good strategy. And because there's infinite risk, open-ended on both sides, you wanted some sort of protection. So along with those at-the-money straddles that you sold, you decided to either buy the wings of a butterfly or just buy the downside because you weren't afraid of, an upside spike. And so you bought out-of-the-money puts or you bought back spreads. And lo and behold, because you didn't spend as much money for those puts or back spreads as you collected with the time premium that you sold, you were still profitable on a monthly basis. But to then imply by that the component of your overall strategy that had to do with the insurance or the buying of the premium or the puts or the back spread was profitable in and of itself is just simply faulty logic. Now, whether it was or wasn't profitable is something you'd have to examine. I would argue that it wasn't. But to say, look, here's a smart guy, he was at a big bank, he made money every month, and so, that argues for my topic. Well, no, it doesn't, okay? Because you could have sold at the money straddles and also bought snake oil along with that and still came out profitable because the at-the-money straddles took in more premium than the snake oil allocation that you bought, okay? So just from a pure logic point of view, it's faulty logic. So I would invite our listener to actually do a study of what it might be like to buy and hold back spreads. And, puts were created in 1974. The smile or the skew didn't exist till after the crash. And if you want to look at the last 25 years worth of out-of-the-money back spreads with puts, do some sort of systematic study of it. The options data is there. I would encourage you to formulate your strategy before looking at the data so that you're not data mining or retrofitting a strategy to the data. Enunciate ahead of time what you're going to do. I don't think you're going to delta neutral hedge these. That's not the purpose, okay? You're not really trying to capture some sort of volatility with a back spread. You're putting it on, leaving it in place, and you're hoping for some catastrophic event to take place where the two farther out of the money puts that you've bought will be profitable with respect to the one that you sold, okay? So go ahead and do that. Say that I'm going to do a buy and hold strategy every month. Define your two legs, how much out of the money you sell, how much out of the money you buy two of. Take all the data, buy these once a month, 12 of them a year, for the last 25 years since the crash. Do 300 of them systematically, and as a standalone strategy, let me know how you made out. Tell me how you did, and let me know. That turned out to be a profitable strategy for you or not. Okay. So,
hey, you know what? Let me guess. I'll bet you Don knows the answer already.
well, I suspect that I know the answer, but I haven't researched it, so I'm throwing it out as a legitimate type of research project. That I would say
sold to you, Don.
Yeah, well,
that you don't already know the answer.
And this is just a comment on the bell curve and things. It's absolutely I concede the point, and it's not a problem. That is that when he says it's Nassim's belief that the market prices are not normally distributed. Well, no, they wouldn't be in any case. They're log normally distributed. The logs are normally distributed. But the point is that data does show us that, in fact, there are fat tails. Data does show us that the outliers occur beyond 3 standard deviations with a higher probability than the standard normal bell curve would allow. And I'm perfectly fine with that. I would just point out, for the sake of accuracy, that where it says that the at-the-monies are systematically overpriced, and so that the bell is flatter, that part isn't correct insofar as the shape, because what you have with these fat tails is what we call a leptokurtotic distribution, or leptokurtosis. And actually it comes from the Greek, which strangely enough doesn't mean fat or tails or anything, but lepto actually means skinny, and kurtosis comes from a root that refers to a hump. So what leptokurtotic actually means is that there's a skinny hump in the middle of the curve, and therefore, to make up for that, there has to be a fatter portion somewhere else, and that's in the tails. So what you get with this type of a distribution that I think our writer meant to say is that you take the middle portion of the bell curve, and as if taking your hands on both sides, you push them towards each other and you squeeze. So when you squeeze, the middle kind of pops up, and you get a skinny hump in the middle, squeezing probability out of that area and sending it to the outsides or to the tails. So if anything, the of this type of a distribution is actually tall and skinny hump, leptokurtotic in the middle, which then implies that there are fat tails on the outside. So
I think Mark and I are now leptokurtotic.
That was there's so many
there's
comments to make here.
Leptocatatonic.
No, but this kind of gets back to what we were talking about on the last show too, where I think we were taking issue with a couple of different things. One is the characterization of the way Nassim has and the media to a degree have characterized his findings of these significant, probably beyond 10 sigma events, given his description in the book that we just read, and how those are the characteristic Black Swan versus some of the ways that he characterized his own trading strategy. I know when I asked Andrew last week, I put him on the spot, point blank, I said, if you had to guess, is he net long premium or a premium buyer or premium seller? Andrew and I think all of us would have naturally assumed he was a premium buyer. The notion that he does these kind of ratios. In fact, we have someone write in. Maybe we'll hit the next question too, because it gets to this. We have a tweet from another Don M. A lot of Dons floating around in the show today. He writes, your Black Swan show, shouldn't Nassim be a net buyer of tail puts if he feels tail risk is underpriced? If he sells at the money, does he buy out of the money on a ratio? Makes no sense to me. Well, that is exactly what Don was just talking about. That is indeed a back spread where you're selling at the money. In this case, he would be selling at the money, buying more out of the money puts on that ratio because he does feel that those out of the money puts are underpriced. So in that sense, he is prepping himself somewhat for that massive move by having more net units. I think all of us can agree at the end of the day, if you are inherent to his strategy, you have to be net long units. There's no other way to do it.
100%.
So that at least is something I think we can all agree upon. I think Asymmetric Risk can as well. And I think his comment that he sells at the money straddles Nassim's, or his tweet, took all of us by surprise. We just assumed he was probably the most degenerate premium buyer of all time because he's made a living essentially writing that way, or at the very least characterizing himself to seem that way. I think we've just more taken issue with the somewhat discrepancy between the picture he paints in his book of this dire Black Swan event and preparing for it and how no one is accurately prepared for this event versus his actual trading strategy where he's selling a lot of premium. That seemed to be somewhat straight for us, or somewhat strange for us.
You know what, Mark? I think the takeaway, and I'm trying really, honestly, it may not sound that way, but I'm trying to be as fair as possible. You may have risk managers at major investment banks where if you say, I want to do huge size in selling at the money time premium, are going to somewhat balk at that, or at least put limits on you that would limit your profitability because of the open-ended nature of the risk. And I'm perfectly fine with that. I sold time premium for 10 years on the proprietary trading desk at Morgan Stanley, and obviously I had to be careful with the size of those positions so that you could make regular good money, but that if something blew up, you didn't close the firm, okay? So somebody saying that, look, if you're going to sell at the money time premium, I'm going to need to see some evidence of some sort of catastrophic insurance policy.
Right.
Okay, I'm perfectly fine with that. So go out and do your back spreads, or go out and buy out of the money puts, so that if something untoward happens every 10 years, like a Black Swan or whatever, you don't shut down the firm. I'm absolutely perfectly fine with that. The thing I'm not fine with is then going on to state that separate portion that you're overlaying, the insurance itself, is a profitable strategy in and unto itself, in and of itself, because I simply don't believe that to be the case.
Don, the interesting thing is that when most people have it wrong, right? Most people think that, when the market is really calm, right, I'm going to make money, when the market's really calm, the retail trader, the average trader goes out and says, boy, vol's really low, I'm going to buy straddles, right? And then when the market's completely blowing up, they go, boy, vol's really high, I'm going to sell straddles. When in fact, you want it, and this is where I think kind of out of the money puts come into play, and this whole concept of back spreading, when vol is super, super low, and we had an entire show on this, that's when you want to be dumping straddles and buying some of that out of the money junk. And when vol is at its absolute peak, that is some of the worst times to be selling straddles. And what you want to be doing is actually owning gamma there and selling all that out of the money junk, because that's the stuff that's getting overbid. And so I think people have a very backward way of looking at premium sales versus premium buys. And if Mr. Taleb had been framed his book that way, I think it would get a lot less scoffing from the rest of the professional world. Does that make sense?
It makes sense. And in fact, I really feel that in a way I did a lot of trading in that particular manner, in the sense that I really didn't always delta neutral trade in order to capture pure differentials and volatility. I also did a tremendous amount of selling of out-of-the-money strangles at times when I thought that, we were going to stay within that particular trading range. And I absolutely agree with you that, when the market is really running violently, that can be some of the worst time to do an at-the-money straddle, because you actually have all of that gamma risk. I mean, what does a straddle buyer want? He wants nothing more than the market to go crazy in one direction or another from of the strike prices. So, I was aware of that. I wasn't comfortable selling those types of positions when the market was going crazy. I'd much rather have a much calmer market, accept a much lower volatility, but still have those options go to zero because they're going to expire out of the money.
Yeah, I mean, Don, you know what the two most profitable trades were coming out of 2008? The short time spread and the put 1x2. Long 1, short 2. Why? Because everybody bid up the curve, and long-term vol got way overpriced.
Yep.
And you couldn't be short gamma.
So you could do 1x2 ratios, maybe, 5-10 points apart, and not even spend anything, have no debit whatsoever, not even worry about one side of the trade, and then, wind up collecting or even doing them for credits.
Exactly. Almost always happened. And then and short time spreads went nuts. If you went out at 2008 and you bought like a Jan at the money straddle and then sold a June against it, you made a blasted killing.
Those are the best kinds of killings, the blasted kinds.
Yeah.
No, I think Don, Don, you've summarized it pretty nicely for us here. If you're a follower of Taleb, you should, and you believe that those out of the money puts are underpriced, you should be able to have a profitable strategy just buying those puts. And even though you're getting hit on time decay a bit here, the amounts you make on these explosive Black Swan events should more than make up for your carrying cost over that time. And you shouldn't need any other components to make that strategy viable, like selling at the money. I mean, that could be ways to juice it, but if that fundamental strategy was sound, you wouldn't need that extra component.
And, again, I'm not going to now switch and be an apologist for him. But again,
you're a Black Swan apologist, and you know it.
Well, here's the thing, understand, so that extra piece there serves as a type of a hedge. And there are people, I've discussed this with people in gaming and sports wagering and what have you. There are people who maintain that if you are an advantage player and you've made a bet that you think has an edge, and now you get a chance to hedge that you should never hedge if the hedge itself is a negative expectation play. The fact of the matter is that I don't always agree with that. If you stand to make $1 million or nothing on something, and you go ahead and put on a hedge that has a slightly negative expectation, but that locks in $500,000 with certainty, for a lot of people that wouldn't be the worst thing in the world. Okay.
Yeah, that's called betting on Monday Night Football.
Okay,
everyone knows that.
So I'm perfectly fine with the notion of putting on a hedge which might be overpriced and have negative expectation, but then just don't ever represent that piece of your strategy is what made you a profitable trader, every month at a large investment bank. And I'm not saying that Taleb said that. Our writer said that, but I'm simply saying that, as I said earlier, the part that made you the money was in all likelihood selling your at the money premium, and the other part, I have all the justification in the world for why you did it, but don't represent to me that you were successful because of that. You were successful in spite of that.
Do as I say in my book and on my lecture tour, and not as I do on my trading desk and in my own personal trading.
So it's like doing a pick six. So Don, if you do a pick six and you're 5 for 5 going into my Monday Night Football, even if you think that Indy's going to cover over Jacksonville, you're gonna sell Indy, or you're gonna sell Indy as a way to lock in your profit. Right? I totally get it.
I would, even if, you handicap the game the other way. And there are people who don't agree with that, saying, that basically you're in it because you put on some sort of positive expectation. But as you just pointed out, when the money and your utility, curve and your personal situation dictates that it would be devastating to lose the tremendous payoff when you can do something that will lock in, even if it's half as much. I mean, each one of us would respond in a different way, but for me, I'd be happy to lock up a very large payday, even if the piece that I was putting on in my own mind actually wasn't in and of itself a very good bet. I'm doing it for a different reason.
So yet another good conversation here about Mr. Taleb. He's certainly engendered some interesting conversation.
It's as much the way he's framed as the way he frames himself.
Yeah, you're right. Some of it is not of his own doing. A lot of it is. Some of it is not.
He doesn't like giving interviews. He doesn't like talking to people. He likes this kind of cloud of mystery. So a media that is, let's say, less than financially savvy, and a guy that puts a cloud over himself creates this mystique and misunderstanding. And it's not entirely his fault. And I think that if you sat down and talked to him in an individual basis, him and Don would probably agree on 99% of trading.
It's a scary prospect. The two of them agreeing.
I resent that.
Let me just close out the mailbag here with an email from Tim Vicks out of Fredericksburg. I think he actually summarizes our points pretty nicely here. He says, let me see if I have this straight. Black swans are extreme outlier events that are unpredictable, yet so catastrophic as to fundamentally alter the course of human events. But the way to prepare for these events is to sell premium. What am I missing? You know what? I like that. I couldn't have said it better myself, Tim. So I think we're going to close out the mailbag on that point and get right into our final segment, the crystal ball segment.
And now we take a look at the crystal ball.
Okay, and welcome to the Crystal Ball segment. This is indeed our final segment of the show, where we peer deep into the murky ether of volatility and attempt to divine what the vol gods hold in store for us over the coming week. And we've seen some, shall we say, repeat performances from a volatility perspective over the past few weeks. I have a feeling we're going to be in store for something similar. Perhaps we'll start with you, Don, and see if you are of the same mind as I.
Yeah, this continues to be a tough one. For the last couple of weeks, I've more or less said that while we are waiting for results from Washington and how the end of year plays out, it's going to be awfully tough to decouple volatility from those results or from market movement. And so if you think that we're going to get some sort of resolution, it actually turns out here that what I think might happen is realized volatility could actually go separate from implied, and the spread might narrow, because if this thing gets resolved with any type of satisfactory solution, I think the markets will go considerably higher. I think implied volatility will drop, but I think that realized volatility could tick up a little bit, because realized volatility is movement regardless of direction, and we could have a very large move to the upside, okay? On the other hand, should this thing reach its limit without any type of satisfactory conclusions and the market starts to go so it would appear to me that actually what we have here is a very good potential with this very low realized volatility, that any kind of movement one way or the other may send it somewhat higher, whereas the nature or the direction of the movement might dictate whether implied volatility goes up or down. So I'll leave the implied to Mark, but I'm going to go out on a little bit of a limb here and say that it's possible, if not in this coming week, but surely in the next 2 weeks, that realized volatility might actually tick up a bit.
Thank you for that, Don. And Mr. Sebastian, what are you watching for the coming week from a VIX and volatility of the S&P 500 perspective?
I think Don said it perfectly. I think realized volatility is in the toilet. I'm a third of implied. I think we are going to see at some point in the next couple of weeks a massive spike in realized vol with little to no spike in implied vol. The trade, and this is why weeklies have been trading at a premium. I think you want to own gamma and short Vega here. So the short time spread, in my opinion, makes the most sense, and or the long variance versus short VIX future. Does that make sense? So I would want to.
You're loving the variance these days.
I know. Well, I love it now. If they ever get their NASDAQ contract, I'd want to own the realized vol contract, and I want to be short the VXN future.
I love it. Some variance love here. It's been a long time since we've had. I think it's been forever since we've had any of that. Frankly, because there really wasn't any way to love it previously. All we had was OTC and shall we say, flawed CFE contract. So there wasn't many ways for us and most of our listeners to really play that marketplace. So it might be an interesting one. Like I said, I knew it launched this week. I was keeping some eye on some of the numbers, but I'll have to keep a closer eye on it going forward in this couple of weeks. It seems like, judging by the open interest, there's some traction there. What's underlying all of that? I don't know. What's driving all of that? Perhaps they've had some success getting those OTC firms on board, or perhaps there's something else going on there, but it's worth keeping an eye on at the very least.
I think the OTC firms are going to use it as a dumping ground.
Well, that's a success for them too. Either way, when they get volume, they're happy. Regardless of I think some of the interesting things that are going on that are underlying that volume. All right, thank you for that, Mark and Don. And as always, before we close out the show, I like to check in with both of my cohorts here on the Vol Views panel to see what they have going on in their respective necks of the woods that may interest you, the Vol Views listener. And Don, since we'll keep with the theme of the whole show and start with you first again, see what's coming up in the land of volex.us.
Well, we've been telling our listeners that we have some major developments as we're negotiating what we hope will be a lovely partnership and a great deal with a major investment bank. So those talks are ongoing, always a little bit slower than we would like, but progress being made all the time. We're also trying to revamp a bit the nomenclature of some of our products on the website and in our literature and in our glossaries. So we've been working to redefine how we refer to some of our products. It's not going to have any great major impact, but readers of the website may see some slightly different terminology from time to time, and that's in keeping with what we're trying to do at the moment.
All right, and last but certainly not least, what is coming up in the land of the pit, Mr. Sebastian?
Go out and buy my book, The Option Trader's Hedge Fund. It has all sorts of interesting things on trading and units and the whole 9 yards. So,
long units. The chapter on long units alone is worth the price of admission, gentlemen.
There you go.
I should say ladies and gentlemen, but I know 98% of you are gentlemen.
So go out and buy my book, and stay tuned for more from Option Pit. I think we're going to be launching a futures options course, and potentially Option Pit and Espanol. So that's kind of next on our agenda.
I had no idea Andrew was fluent in Espanol.
No, I think we're gonna work with a new partner that speaks Espanol.
All right, so thank you for that, Mark, and thank you for that, Don. And of course, if you'd like to find out more about any of the topics we discussed on today's show, if you'd like to join any of our commenters and listeners in joining us on the old mailbag segment, then by all means surf on over to theoptionsinsider.com. You can leave your comments and questions for us here on the show in our comment system. You could do it via email. Shoot us an email, questions@theoptionsinsider.com. Just make sure you put somewhere in the subject Vol Views so we know what show you're referring to. You can reach out to us on Twitter or on Facebook. There's a myriad of ways to reach out to us here on the old Volatility Views program. And of course, if you've missed any of the episodes of this show or any other show on the Options Insider Radio Network, by all means, you can find them all on the optionsinsider.com. We've just revamped a lot of those landing pages to make it even easier for you to find all the episodes of your favorite shows. Of course, you can find them in iTunes or in Stitcher or anywhere else your favorite podcasts are purveyed. And that's going to do it for all of us here on the old Volatility Views panel. But before we go, we'd like to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program, and of course for chiming in and making the program such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.